Welcome back, grade 11s. Now, let's look at our first concept for our lesson. Differences between forms of ownership. Definition of form of ownership. Form of ownership refers to the legal position of the business and the way it is owned. An entrepreneur must decide which of the forms of ownership will best suit their type of business. So it will differ in each and every entrepreneur that which form of ownership will they see it's best or suitable for them when they want to start their business. Not to say all of them there have to follow one form of ownership, but it will depend on them which suit them best. So here's the following 7 types of ownership. We have a sole trader, we have a partnership, a close corporation, a private company, personal liability company, public company, as well as the state-owned company. Now, let's look at the difference between a sole trader and a partnership. We'll look at the business name. Under sole trader, own name as per ID or name registered with the Companies and Intellectual Property Commission, CIPC. So the name of a sole trader, it can be the one of the owner as it appears on their identity document or the name that they have registered. Then with partnership, name must be registered with the Companies and Intellectual Property Commission, CIPC. So with the partnership, the name also has to be registered with the CIPC, and then they can call their partnership with that name that is registered. Number of owners. There's only one owner under sole trader, and at least in a partnership it has to be 2 partners and more. It cannot be 1 because now we are referring to a partnership. A partnership consists of partners, and partners may own the partnership as there are 2 or more. Managed by, the sole trader is managed by the owner because he's alone, and then the partnership can be managed by the partners. Then liability of debts. Unlimited debts under sole trader. As we've said before, that the owner of a sole trader and the business are inseparable. So whatever debts that are in the business, they belong to the owner. And under partnership, jointly and severally liable for the debts. So partners are jointly liable for the debts of the partnership. It's not only one partner who has to pay for the debts of the partnership, but all of them as partners, they are jointly liable for the debts of the partnership. Business name. Now we move on to private company and public company. The name of a private company must end with Pty Ltd. And then the name of the public company must end with Ltd. Then you would know very well that this is a private because it ends with Pty Ltd, and then this is a public because it has to end with Ltd. Number of owners. For a private company is only 1, and for a public company at least 2 owners. Then shares of a private company may not offer shares to the general public. So a private company cannot sell or transfer their shares to the general public. But in a public company, shares are traded on the Johannesburg Securities of Exchange, meaning they are able to sell shares to the public at large. Annual financial statements. The annual financial statements of a private company need not be audited and published. So there's no need for the private company to audit their financial statements. Unlike the public company, their financial statements has to be audited and they have to be published so that even prospective investors can see how they can see actually the financial position of the business, and they can be able to invest in a business through seeing their audited financial statements. Now let's move on to the second concept, where we look at the benefits and challenges of establishing a company. We'll start with the benefits. The following benefits will encourage entrepreneurs to establish a company versus other forms of ownership. We'll look at the legal status and liability first. A company has its own legal status, trading name, and owns its asset. So under legal status and liability, the benefit is that the company can be registered and have its own name. A company can have its own asset, meaning we can buy assets in the name of the company because it has a legal status and liability. Then profit sharing. Shareholders have a share in the profits of the company in the form of dividends. Another benefit is that of establishing a company is that shareholders get to have a share in the company's profits through dividends. They get dividends. Another benefit, ownership and management. Shareholders are able to buy and sell shares freely in a public company. So another benefit of establishing a company is that you are able to buy shares, and if you no longer need those shares, you want to sell them, you can easily do that, or you can transfer them to someone else. The company is managed by qualified and competent board of directors. Another benefit of establishing a company is that even if you, the owner or the incorporator of the company, does not have the necessary knowledge of running a business, shareholders can appoint competent directors who can be able to manage the company. Then another benefit, capital and cash flow. A company may have more investors to fund the setting up of the business. Here's another benefit. Capital and cash flow. In a company, we can get investors to invest. We can raise huge amount of capital through our investors because we are able to sell shares, and in that way, we are able to get more money in a company. Companies have a better cash flow than sole traders. Unlike sole traders, the owner is only limited to what they can contribute in the business. But with a company, we have investors, we have shareholders who can buy shares in the company. In that way, they are investing, and in that way, we are getting a lot of money as a business. Then we have lifespan and continuity. A company has continuity of existence, meaning even if the shareholders decide to leave the company will continue to exist because it's registered, it can trade in its own name, and we can even find other shareholders to continue raising capital as a company. Company shares can be transferred, bought, or sold. Another benefit is that the shares that you have in a company, you can be able to sell them if you want to sell them or even transfer them. So that's another benefit. Then we look at taxation. Companies have tax benefits that other enterprises do not have. They may obtain tax rebates if they are involved in social responsibility projects. So another benefit is that if you are involved in social responsibility programs, you can get tax rebates from the government when it's time for filing. Now, let's look at the challenges. The owners of the company have more liability. It simply means that the challenge here is that as the incorporators of the company, you may end up having more liability if the business cannot pay its debts. So it's a challenge. If directors change, there might be a difference in the continuity of management. So another challenge is that if directors change, maybe they decide to leave for other businesses, or we decide to change directors, there's going to be lack of continuity in terms of management, because whoever that is going to replace those directors who have decided to leave the business is going to want to use their strategies to run the business, of which it can take time maybe for even employees to adjust to the new changes. Another challenge is that directors may not have a personal interest in the business, and this could prevent the business from gaining help to maximize growth and profits. So another challenge here is that you may find that we have appointed as shareholders the directors who are not interested in the business, who are not going to take risk or even find investors so that the business can grow. So that can also be a challenge. Now let's go for a quick ad break and we will be back. Stay tuned.